Welcome back to Current Topics in Finance. I am Andy Kim, your Dr. Finance. In this video, we're going to go through an R code, how to backtest and see the size strategy must have worked or value strategy must have worked in Korea over the past, 30 years or something. Okay? And then you see on this graph, this is what we're going to generate on our own using this code. What you see on the red line is SMB, small minus big, the size-based trading strategy using Korean data. And then value strategy on the black line, HML, right? So it's going to be the factor portfolio performance that we're going to demonstrate. And then how do we do that using Korean data? There are some warning points that I have to make, right? Easier said than done. First of all, the size and value based, portfolio sorting, we have to do it. Double sort, we have to do. Okay, first to sort by size, small all the way down to big, thousands of stocks every year, you have to do it. Size, market cap based ones, okay? And then book to market, that's book value of equity divided by market cap, right? And then we also sort every year, right? We sort them from highest book to market to lowest book to market, top 30, bottom 30, mid 40%, all right? And then we're going to have 6 different portfolios. Each different ones we're going to construct value weighted portfolio returns, right? RSH, like that. And then 6 different portfolio returns, you're going to have it. What's next? You're going to construct the equal weighted portfolio returns like this. Small returns minus big returns. That's going to be your small minus big factor portfolio, size factor portfolio returns, right? That's size strategy we're going to backtest. This is for US market, but Korean market, nobody knows. I told you, I showed you the picture before. And the value portfolio strategy, well, how does that work? Well, these 2 portfolios, small high and big high, that's value portfolio. Simple average of these 2. And then low book to market, which is growth stocks, small growth and big growth. And simple average of these 2. Take the difference of it. That's going to be your value factor portfolio return, right? HML portfolio return. So we're going to compute these things period by period, annually, and then accumulate everything like that. Okay? And see how they perform, right? Of course, rebalancing will be done every year, but the return will be monthly based. So you're going to see a lot more bumpy graph like that. Now, again, easier said than done. Why is that so? Well, compared to the momentum trading that you checked last time, right? Here is a complication. Momentum, well, we did not have to worry about accounting data. It was purely based on, stock market data, right? But when it comes to book to market, when it comes to value factor, right? One of the component or the numerator, the book value of equity, comes from accounting data. And accounting information, right, comes every year, not every second, right? Forget about quarterly earnings announcement and things like that, right? I know it's more frequent than that, but annual frequency, let's consider it. And that was standard way of doing it ever since Pharma French 1992 and 93. They use June rebalancing. What is that about? I'm going to talk about it from now on, so wait. Now, book value of equity, right, is coming up every year, right? And then book to market is the inverse of PB ratio, right? And then that really depends on the book value of equity that you observe, okay? And that book value of equity is as of usually the end of December 31st. At the end of December, end of every fiscal year. In the US market, the fiscal year ends, it can go everywhere. Okay, 80% or 85% of the company's fiscal year finishes as of December 31st, right? But still 15% of them or 20% of them, their fiscal year finishes in January, February, you name it. Like, it's all complicated all over the world, right? All over the timeline. But in Korean market, almost all of the companies, their fiscal year finishes as of December 31st. Okay? It makes your life a lot easier in this computation. Now, so I'm using Korean data over here so that it will be easier for you to follow and then understand what the heck is going on over there. So at the end of each fiscal year, right, you're going to have a book value of equity. And then also your PB ratio. You can think about that PB ratio idea of, the growth stock versus value stock as of the end of each fiscal year end. You can think about that conceptually. But the trouble is, this book value of equity is not published yet. Remember, so many of you want to become a CPA. I know you guys run for CPA exam. What are you going to do? Well, once you become a certified public accountant, your job is to certify and go through the accounting reports of every listed companies and the big companies, right? And then the thing is, let's say Samsung Electronics or, their book value of equity as of year 2019, right? 2019, at the end of December 31st, their book value of equity is not visible, is not observable. Why? Because it has to undergo the scrutiny, which is called auditing, right? 감사, right? They have to do auditing from the end of December and then until maybe middle of February on these days, right? Middle of February, or it goes to March or sometime, right? In 1990s or even before that, it took longer amount of time, so that it may have gone to March or April, things like that. Okay, so the book value of equity, right? And then PB ratio based on that book value of equity as of December 31st is not something observable until April or May time. But by the end of May, pretty much it will be visible. It will be a public information. Remember, value strategy was about defying the notion of semi-strong for market efficiency. And that semi-strong for market efficiency was about what? Publicly observable information, right? The PBR. When would it set? When do we set the PB ratio of a certain company? Well, that one at the end of each fiscal year, but it's going to be observable after a certain point, right? 5 months later or 6 months later. And then Pharma French said that let's assume this PB ratio is observable from the June time of the next year, T+1, right? So 2019, 2020. 2019's PB ratio, right, at the end of December, that PB ratio will be observable from June, so that you can rebalance your portfolio at the end of June period, okay, based on PB ratio of the December 31st, okay, of the previous year. That book to market, just to flip the PB ratio, right, inverse of it, as of 2019, starts to be valid from June of 2020, right, T+1. Don't get confused. People get awfully confused at this point, all right? We just give some enough of time, right, about 6 months before this gets observable, okay? That book to market ratio, numerator, denominator, commonly as of December 31st, okay? We just give them enough of time, all right? and then it lasts 12 months until, which is end of May, right, of T plus 2, which is 2019, 2021, right? And then by the end of, by June, right, by June of the year T plus 2, what do? Well, June is rebalancing time, right? June is rebalancing time based on the book to market ratio of T plus 1 that happened about 6 months ago, right? That's why, unobservable because of auditing, right? That's why I use dashed line, dot, 점선, right? Over here. And then dashed line one more time and time again. We just give them enough of time, like 6 months like that. Just remember June rebalancing, simple and easy, right? June rebalancing, well, that also goes for market equity when it comes to size, right? Size. So market equity, right? Market cap, number of shares outstanding times the price per share. Well, we just catch the market value of equity as of the end of June each fiscal year. So size of T goes until there, and then size T plus 1 goes until this, and then size T plus 2 like this. So based on size, we also rebalance our portfolio as of June like this. Okay? But one more time, don't get confused. The market value of equity that goes over here in the book to market ratio is as of December of year T. Not this guy. Why is that the case? Because this book to market, the idea of book to market is to catch the PB ratio, right? PB ratio as of this December time. The book to market separately, we just measure it. It's just not feasible until until certain time. That's it. So over here is about December time. Over there is about June time. Don't get confused. People get awfully confused in this one. But that's the basic idea of what's going on. And then it's time to go through the R codes for this process. Okay. Strategy. Now, R codes, I give you this one in the shared drive. So go ahead and download this guy. All right. So what do? Well, let's remove what I did. Yeah, and then restart it. Okay. I'm going to remove everything and then set the working directory. The initial procedure, you have good explanation in my previous video about momentum strategy. So go ahead and watch what these are about if you don't remember what the heck these are, right? Because here the computer is asking me if I want to turn off the computer and then reinstall all these packages because I'm running it again. But the thing is, I already installed this before I record this video. So I just have to cancel all these things. Yeah. And then clean up. And then over here, I just want to make sure I check with the library, and then the packages are ready to use. And then I just use 3 data sets over here. Korea Stock Exchange Adjusted Stock Price, CSV, Korean Stock Exchange Market Cap Data, CSV format, and then Korean Stock Exchange Total Equity. This is book value of equity. Again, this is accounting numbers. Every year, yearly frequency, whereas that guys are daily frequency. So let's import it. And then what? Wait until it gets activated. It takes time since the video programming is on, using a lot of RAM. Yeah, we just have to be patient, not painful. Patient. And then uh, yeah. I just found that I can pause, right, in my video recording. So let's pause and then let the computer run. Okay, so the next thing that you have to worry about after importing these data is to make sure those date, right, date variables, whether you call it index in this data set or date variable, it doesn't matter. But just to make sure, we have to make sure all these things are recognized by the computer as date correctly. And those things are done by this, all right? Change the format, time date, right? And then we now have 3 data sets, which is PRC, stock price data, market cap data, and then shareholders equity data. Let's open SEQ data just to see how it looks like. Takes time. And abracadabra. Bah. Doesn't show. Oh yeah. Good. Now you see the frequency. December 31st. Yeah. Simple and easy, right? All the Korean firms are December 31st. No exception, right? No fun, but gives an easy life for you, okay? If the fiscal year end is like some companies, like March sometime, you're gonna be in deep trouble. Anyway, so that's that. And then Samsung Electronics over here, all different companies down there. Now, close it. For PRC and market cap data set, remember these are daily data. Now what you want to do is reduce it into monthly data by picking up the month end price data. Okay, month end, not the beginning, right? Month end. And then you see all these things popping up because, I mean, it takes time because huge data set. January 4th, 5th, 6th, and right? Daily data, but you want to reduce it into monthly observations. Similar things for market cap, and then let's just do that first. And then, because we are going to do June rebalancing, okay? We're going to take the June values for market capitalization. Subset data for June and December are needed right now. Okay. Remember, market cap of December is used to calculate the book to market data. Okay, book to market. And then the June, we need this for our size variable, right? So that's that. December, well, you notice that January month value is 0. This is computer starting with 0. If you're a user of Python, you must be familiar with this kind of starting with 0, right? If you're Europeans, you're comfortable with using this 0 as a starting base because the building level starts with 0 level and then 1, 2, 3, 4. But Koreans and then, we are not used to it. But anyway, so what we need is 5 and 11 as June and December, right? We label that data like that and then enter it. Calculate monthly return. Well, now you have monthly return data, price data based on price, calculate return, and then Winsorize those returns at top and bottom 0.5 percentile level. Why? Because there are some extreme observations that can drive you crazy. Outliers, you have to reduce it. Okay, instead of trimming off, you still want to use those information and then you do some statistical inference of it. So that's why we do Winsorization. Now it's time to do size and value portfolio. Okay, calculate book to market ratio of the same year's December. Take negative book to market to be missing value. NA, nah, yeah, drop it. Okay? So these are the ones that we do. First of all, divide SEQ, shareholders' equity, the accounting number as of December 31st, by market cap of December. I told you it's the same time point, December. Okay? It's available in your data, so we do the calculation, but it was invisible to the investors right after those fiscal year end. January time or February time, it was invisible from the perspective of the investors. So that's why we're going to give some enough of time later to rebalance it as of June. But for this calculation purpose of the book to market ratio, it has to be based on the December time. Okay? Yeah, that's that. And then missing value, nah, yeah, drop it. Now, align the calculated book to market ratio with the last trading day of next June. Okay? So, this is how we do it. Yeah. Right? And then calculate annual breakpoints by book to market. Now, BM, before we move on further, let me open this BM data set. What do we see? What do we see? Book to market value for 3,000 different companies in Korea. And then you see June 30th, right? End of June, we have book to market value of Samsung Electronics. And it goes until what? Yeah. You see June 30th. Did I see June 31st before? No. June 30th and then 2021. Right. This book to market value, 0.5, is actually coming from the December of 2000. December 30th of 2000. But we attributed this number to June of 2021. Just to shift it by one period. All right? Next fiscal year, middle. Right? We just gave enough time, as if we are putting ourselves in the shoes of the market investors as of the investment period point, right? That's what backtesting is about. So that's why one period pushing down. That's what's happening. This guy, for example, 0.71, it was calculated as of December 2019, December 31st, right? PB ratio inverse, it's this guy, okay? But we just pushed it by 6 months to the next calendar year because it was not observable from the perspective of the investors in the market in January time or things like that, right? So that's that. Book to market, yes. Calculate annual breakpoints by book to market. This is just like what we did in momentum portfolio, right? We are just replacing it with book to market standard, okay, book to market way of sorting it. And then 0.3 and 0.7, high book to market, low book to market identifier. We are going to have those things, right? And Q1 and Q2 threshold will be given as of BM quintile, BM underbar Q. BM underbar Q, they are the, BM underbar Q. This is the quintiles of the breakpoint of book to market. So as of 1989 June, right, the top 30 percentile breakpoint is 0.97-ish over here. And then bottom 30 percentile of book to market is like 0.54. Okay, how about most recent one? Top is like 1.172, and then bottom is like 0.428. So that's 30%, 70 percentile breakpoints. Okay, we're going to use this one and then check each and every company in each and every fiscal year, June 30th, book to market ratio, and identify if they belong to any of these two groups. Okay, so calculate annual breakpoints. That's book to market ratio. We're going to do that later, but before that, we are going to calculate the market cap of each and every company as of June, right? The size-based sorting has to be done, and then this size come from your market cap, right? It's the same market cap, but different time point. The size is as of June. Okay, as of June, on the month, right, like that, and then market cap. So median split has to be there. Median split has to be there, and then right, and then to calculate time series weight for each asset, what we have to do is market cap Q is generated, and then we are going to identify the companies, small company, big company, based on market cap in these two lines, and then high book to market and low book to market and mid book to market using this BM quintile data set, right? Using these two different data sets, market cap and then book to market. Okay, so that's that. And then big value and neutral, right? Now big value, big neutral, and big growth. You remember the 6 different portfolio identifier? We have to do it. So these are, the steps to do to identify those 6 different portfolios, right? Based on the size and book to market. Now what do? For each different portfolio, you want to calculate the value weighted portfolio returns. So for that part, we need to compute the values, the value weight of each different portfolios. Value weight means the value should be based on the market cap, all right, as of June. Yeah, right. So that's this one. Core data, then you take the data value from market cap June for each and every stocks, and then also what you do for each different month, right, each different year, right, you have to calculate the weight of each, right? Weight, market value based weight for each different company's market cap. You divide the market cap of your company by the aggregate market value of the portfolios in that segment, right? 6 different portfolios. Big value, big neutral, big growth. This is the sum of those market cap in that portfolio, and this is the market cap of your company. Okay, Samsung Electronics divided by all those big value companies. Is it value? Yeah, if it should belong to here, and then all those stocks over there. Right, and then change it into time series format so that you can do some analysis, right? And then we need index value for each and every stock, and then that's how we do it. Replace NA, the missing value, with 0. Okay, we replace missing value with 0, and then calculate monthly portfolio returns. Yeah, portfolio of what is it? Big value, big neutral, big growth. Those 6 different portfolios, right? Returns, right? And then calculate factor returns. How do you do that? Well, the first factor is size-based one, SMB. The second factor is HML, high minus low, right? They are simple average of those component portfolios. For size, you had three portfolios and three portfolios for small minus big, small minus big, right? And then HML, you had two value stock portfolios minus and low book to market, right? Growth stocks portfolios. So those simple averages, right? You subtract and like this. Okay, that's the calculation done over here, month by month, and then HML, SMB are constructed like this, right? You see this? Now, what do? Well, I want to chart this guy, right? First of all, seeing is believing. So, chart it. Can't see it. Here you are. Yeah, size factor portfolio return of Korea looks like this. It once performed well, but not nowadays, right? The magnitude-wise, 0% return to 100% and 200% return. It could have been going up like that, but ever since the beginning of 2001 or 2002, the size strategy sucked. Why? This is when the typically small companies perform awesome good. When did these small companies perform great? Well, dot-com bubble period. Okay, that was when all those internet ventures were booming, and we're going to talk about this. Other class, my behavioral finance, by the way. I'm sorry, but this is typically those period when the small company performed better, and that used to be good also in before the East Asian financial crisis, and then it tanked. Bigger company performed better compared to small companies when the crisis came, when the bubble bursted. So the size strategy sucked, and then it never came back until now. Cannot recover this stage. Think about Kosdaq index. That Kosdaq index, you go back in 2001, the highest period. Okay, that index number in Kosdaq, we never reached back yet. That's consistent with this, phenomena over here. And notice that in South Korea, everybody invests in what? Samsung Electronics, which is supposedly the biggest company in Korea, taking up more than 25% of your market cap. One single company takes up more than a quarter of the market cap of the whole country. Okay, big company, and it performed well over the last decade or 2 decades, which means size factor sucked. Yeah, of course. Big corporations, 재벌 companies perform better in Korea. That is unique over here. Anyway, and then the next chart is this one. Okay, value factor, how did it perform? Show me the picture. Yes, over here. I'm too big. Is there any way I could show you? Yes, like this. Yeah. Yes. So it was performing a lot better, right? Size was playing around 0 to 2, right? But value factor performed up to 12 times, right? 12 times. Up until here, right? That's in the middle of 2010s, right? But recently, the value factor has been performing poorly. Okay, value company has been performing poorly. Growth stocks have been performing very good, especially after the pandemic. You remember that pandemic? And then the 동학 개미운동 thing, right? The individual investors rushing into those growth stocks. It's different from small stock. It's different dimension, right? You can be fast growing with big size as well, right? Tesla is a big company as well. That kind of things. We don't have Tesla in Korea, but equivalent thing in Kakao or Naver kind of guys. They have been performing very good, right? Growth stocks have been performing very good relative to value stocks. That's why the value strategy sucked over the last year. And like this, right? So that's value factor performance, factor portfolio. And then, and then factor. Now what are we gonna do? We want to chart everything in one picture so that we want to put them into a perspective. Compare, right? Relatively, how did these two portfolios strategies performed, right? Like this. Yeah, like this. Value versus size. You can see it one eye. Picture is worth 1,000 words. And make sure you make it your habit to graph everything in one chart, or not everything, but the comparable things, right? So that the reader can easily see the difference. Oh, yeah. In Korean market, the size strategy did not work. Value strategy used to work better. But nowadays, value strategies doesn't even work. Okay. Now, would the value strategy keep on sucking like this, or would it revive itself? Nobody knows, right? If it were purely, if the value phenomena is purely mispricing, and then what will happen is that over time, people eat on these mispricing. People make money make money based on this value strategy, so much so that the value opportunity depletes itself, right? So that there will be no more money making opportunity by doing value strategy. That's mispricing story. If it should be, if the value is a systematic risk, right, then this kind of things will come and go and reappear, right? The value premium will sustain and show up again in the future. Okay, which one, which side do you stand? Okay, it's up to you. That's that, right? And then t-test using Dewey West adjusted standard error using 5 lags. It would be like this, and then just to see whether value or size strategy were making a significant amount of money using Dewey West standard error, and then monthly return on average monthly return of the value strategy was positive 78 basis points, which is like a 0.78% every month, like, right, on average. So multiply it by 12, it's gonna be like what? About 9%, okay, about 9% annually, and statistically significant return, okay. And how about SMB, small minus big? Well, magnitude is smaller, and then t statistic is much smaller, which means it was not significantly making money, okay, which is confirming our intuition by looking at the graph, right? Thing is, these ones are not abnormal return, but this is just a simple return. I never talked about alpha over here. It was just a monthly return, okay? So that's one caveat that I have to tell you, okay? Does this thing happen one more time if we try to estimate alpha of every month using CAPM? That's a separate or different, or like a bit different testing that you have to do. But I'm not going to cover that one in this class. I'm not going to expect you to do it in this semester. Don't worry about that part. But the alpha is the ultimate testing that you want to do, and that's the scope of master's degree program or something. But in this undergraduate class, I'm not expecting you to do that. But just have a taste of it, right? This is it. So I hope you liked it, and then I hope you can replicate this kind of things and go through each and every step of this code and learn yourself, right? Thanks for watching, and see you. Bye-bye.